In this session we're going to look at IAS 10, Events After the Reporting Period. So we're going to first of all explain what we mean by this term events after the reporting period, and then describe the two different types that we have to worry about. We'll then explain how to deal with the first type, that is adjusting events. We'll also cover how to deal with non-adjusting events, and lastly we'll look at two special cases which we have to know about. First of all, we need to define what we mean by this events after the reporting period. Well, here we're talking about events that occur between two particular dates. The date at the end of the reporting period, so typically the year-end date of the accounts, and the date on which those accounts are actually approved and signed off by the directors and authorised for issue to the shareholders. Now there are two types. There are what's called adjusting events. Now this provides us with information about the company's assets and liabilities at the period end date. It's just that that information was not available at the period end. The second type of event are what's called non-adjusting events. Now these are events that happen after the period end, but which don't tell us about the conditions that existed at the end of the reporting period. So essentially it's everything else that's happened other than an adjusting event. So we'll look at adjusting events first, and we'll consider some examples to illustrate what adjusting events are. So a first one might be the settlement of a court case. Now the settlement might occur after the year end, and until that court case is settled we might not have known how much we would eventually have to pay. So there was a liability at the year end, but at that year end date we didn't know what it was going to be. A second example would be a bankruptcy of a customer after the period end, because that would tell us, or it would provide us with some information as to whether at the year end date the debt that was owed by that customer, whether it was bad or not. Thirdly, we might look at the sale of inventories after the period end date, which might give us information about the net realisable value at the year end. So for example, if at the year end I had a piece of inventory that had cost £1,000 and a few days later I sold it for £600, it's probably the case that it was really worth £600 at the year end date. A further example would be the discovery of errors or fraud that occurred before the period end date but were only discovered after the year end date. Or lastly, the confirmation of profit sharing bonuses. So at the year end date we know that some bonuses will be payable, but until the accounts are prepared and the profits made in the year established, we just don't know what the bonuses are going to have been. So what do we do where we have an adjusting event? Well, the treatment is very straightforward. We amend the figures in the accounts to reflect that adjustment. So for example, a company has a year end of 31st of December 2014. After the year end it loses a long running court case. So whatever it is that we did wrong, we must have done it before that year end date. We're ordered to pay £10,000 in damages. So what do? Well, in our year-end accounts for the year ended 31st of December 2014, we would record an expense for damages of £10,000, and that would be reflected in the income statement. We would also record a liability for £10,000 in the statement of financial position. So that's relatively straightforward. An adjusting event, we adjust the figures in the accounts. We'll now turn our attention to non-adjusting events. And if you remember, a non-adjusting event is something that happens between the accounting period end date and the date that the accounts are signed off by the board, and which are not classed as adjusting events. Now, a moment's consideration will indicate to you that there is an enormous number of non-adjusting events occurring between these dates. So, accountants will only focus upon non-adjusting events that are what's called material. And by material, we mean that they will have a significant impact on that company. So let's have a look at some examples of material non-adjusting events. Well, first of all, we might have the major purchase or disposal of another company. And notice the focus on the word major. Secondly, we might announce a plan to discontinue an operation or reconstruct the company itself. Again, it's going to be a major change or a significant change to that business. Thirdly, there might be a major issue of shares and debentures after the period end. And again, the focus is on that word major. Or lastly, we might have the destruction of a major production plant by a fire after the reporting date. So all of these events will have a significant impact on the company. So how do we deal with that? Well, where an event is material, such as the examples given, we will disclose in a note the following information. We will state what the nature of the event was. We will estimate what its financial effect was, but what we won't do is we won't adjust the figures in the financial statements for this event. The reason for that is because it happened after the year end, and the accounts should reflect the conditions and performance of the company in the period under review. Let's have an example. So, a small company has a year end of 30th of June 2015. At its year end, it had inventory of £50,000. But in July, the company had a flood in which all of its inventory was destroyed. Now, this is a small company, so it's likely that the loss of inventory of £50,000 is going to be a material event. Now, if it's a material event, we're not going to change any of the figures in the income statement or in the statement of financial position, because at the end of June, all of that inventory was owned. But what we will do is we'll include a note in the accounts. It's going to say that a flood has occurred. It's going to say that inventory costing £50,000 has been destroyed. It might also state whether the inventory was insured and the amount that would be likely to be gained from the insurers. So it's going to state what the financial losses caused by the flood have been. Lastly, we're going to consider two special cases. The first is over an issue of going concern. Now, if you can remember, the going concern principle is one of the fundamental principles of accounts. It tells us that unless there is a good reason not to apply it, we assume that companies and businesses will continue to trade or be active in the future. Now, occasionally you might have a situation where a management team decides after the period end that it intends to liquidate the company or cease trading. Now, in that situation, this is an event. This is something that occurs after the year-end date. And doesn't reflect conditions at the year-end date. So normally you would say that's a non-adjusting event, but in fact we would treat it as an adjusting event, and then when preparing the accounts for the period end, we would not be making the assumption that the business will continue into the future. The second special case that I want to comment upon is dividends. Now, we do have different types of dividends, and two of the main ones are interim dividends. Now, these are dividends that are declared by the directors of a company, and they are paid at the same time as they are declared. So the managers, the directors, decide to declare an interim dividend on the 1st of June, they'll be paid out to the shareholders on the 1st of June. And what we do with those is they should be included in the statement of changes in equity and in the cash flow statement. The second type of dividend are what's called final dividends. Now, a final dividend is typically referred to as the final dividend for the year ended, let's say, 31st of December 2014. So you might imagine that that final dividend for the year ended 31st of December 2014 should be included in the accounts for the year ended 31st of December 2014. But in fact, they should not. And the reason for this is because final dividends are voted upon by shareholders after the year end. And they're voted upon when the shareholders agree the accounts. So at the year end, that final dividend hasn't in fact been authorised just yet. 99 times out of 100 it will be paid, but there is the possibility that it might not. So it should not be included in that year's accounts. It would in fact be included in the following year's accounts. So in my example of a final dividend for the year ended 31st of December 2014, that final dividend would be shown in the statement of changes in equity and the cash flow statement in the accounts for the year ended 31st of December 2015.